Hi everybody, Marco Carbajo here from businesscreditbuilders.org. Today's video we're going to talk about the question that you may be asking is how to get funding for my startup. What can I do? What options are available? So this is the video for you. We're going to share with you 3 powerful funding options to get cash and or credit for your newly formed business. So let's get started. So if you look at the internet, there's lots of different definitions of what's considered a startup. Some people say you're under 5 years old if you're a startup, or you're under 2 years old if you're a startup. You're doing X amount of revenues, you're still classified as startup. If you have so many employees, you're still classified as a startup. So I want to clear that confusion and give you our definition of a startup for this particular video, because these funding options that we're going to present to you are ideal if you fall into this particular category. Now keep in mind though, if you don't, that's okay. There's still obviously options that you may entertain for getting funding for your small business. So if you're a startup, for the purpose of the video, you've already structured your business or you're forming your entity, whether you're a sole proprietor, LLC, or corporation, you're in the initial stages of your business. So you may be planning your business right now, you may be setting up and wanting to start marketing your product and service, or you may be developing a product or developing your website, or you haven't gotten customers yet. So you're just in the initial stages of your business, and your business is under 2 years old. So you may have already launched your business, but you're just getting a couple clients here and there or a couple customers. You literally have little or no revenues going through your business yet. So that's the definition of a startup for this particular video. Okay, so if you fall into this, great. I'm going to share with you some funding options where if you have no revenues, you could still get funding. If you're under 2 years old or you're just formed your entity today, you could still get funding. And if you're in the initial stages of your business, so this is what I'm classifying you as a startup. The first thing you need to do is to first know your FICO scores. We're going to share with you the first step. So that way you'll know if you fit into any one of these 3 funding options as a startup. So you have to know what your credit scores and your credit report looks like. So I encourage you to order all 3 bureaus. You want to know what all 3 credit reports look like and what your FICO scores are. Now there's lots of free services out there that'll give you, there's Credit Karma, that gives you your Vantage score, so it's not really your FICO score. So there is a variation in the numbers there from the score from Vantage to FICO. So you want to get your actual FICO score. So you can go to knowmycredit.org. They charge $1 to get all 3 bureaus and your FICOs. I do encourage you to use that service, stay subscribed to it. That way you're always on top of your credit reports and your FICO scores. Once you know what your score range is, I want to break this down to you what you can expect. Because when it comes to getting funding or even getting credit, you have to know what your scores are, where you stand first. Okay, so if you're in a lower score range, if you're under the 669 score range, then you get to realize if you're going to apply for funding, you're going to get a higher interest rate, okay? Because you're more of a risk. Where if you have stronger credit, you're going to have better rates, better terms, maybe even higher credit approvals or loan approvals, okay? So that's the first step you want to do, is know what your credit looks like. So once you've done that, you know where your scores are at, you know where you stand. The second thing you want to do is do an assessment in knowing your banking relationships. Why is this important? Before you go and get funding, you're a brand new startup, you have to know what leverage you currently have. And when I talk about leverage is what type of relationships do you have? Where do you do your personal bank account with? Have you had a personal bank account with your credit union for several years? Have you had a personal bank account with Chase or any of these banks? You have to know what relationships do you have already, so those will be the relationships that you're more likely to get additional credit or funding with first for your business, okay? So you have to leverage your personal assets, your personal banking relationships. So who do you have credit cards with on the personal side? Do you have an American Express personal credit card? Do you have a Chase personal credit card? Do you have a Navy Federal personal credit card? So all those relationships you have with those credit issuers, those are relationships that you can leverage. Now, what do I mean by that? For example, if you have a personal credit card with American Express, let's say you've had it for 5 years, you have a relationship with American Express, you had your personal cards with them, and now you're starting a business. Well, the first place you should go to get a business credit card would be American Express, because you already have a relationship with them. You're already in their ecosystem, okay? So they will more than likely approve you for a business credit card because they already have your personal credit card history. They won't even do a hard pull on your personal credit when you apply for a business card if you already have personal cards with American Express. Okay, so that's called leverage. So I'm already giving you some strategies there is to leverage your current credit card accounts. Okay, loans. Do you have any previous loans that you have, whether it's a mortgage or a personal loan that you may have paid off with a credit union or a lender? That's a relationship. That's history that you had. So when it comes to getting funding for your business, you want to go back to those particular relationships. Do you have lines of credit? A personal line of credit with your bank. Well, now you can approach them for maybe a business line of credit or a business credit card. The third thing you want to do is you want to list your assets. Now, when I'm telling you all these things is put all this on a piece of paper before you actually go out and say, okay, I want to get a loan here. I want to get some business credit cards here. I want to apply for this. You want to first leverage all the tools that you have already established that you've worked hard to build up to, and now use that to help propel your business to that same level. Okay, so on your list, your assets, when people talk about assets, you think like money, you think about, what type of real estate do you own, but one of the assets that's not talked about is your credit. Your personal credit is actually an asset for you. Why is it an asset? Because if you have good personal credit, that allows you to leverage that as a tool to help your business get credit and funding as a startup. If your business has no credit history, it has no revenues coming through, it's brand new, it's considered a very high risk business because there's no track record. Okay, but if you as an individual have good, strong personal credit, you can co-sign for your business and allow your business to raise capital, raise credit without even having any type of track record. So that's leverage for you. So that's an asset. So first you want to list what are your assets. If you have good personal credit, then that's an asset. How much cash do you have? Do you have cash in the bank? Do you have cash in other sources, whether it's in inventory or personal property that you have? But cash on hand is just flat out cash. A lot of people try to get funding for the business because they don't want to use their cash. That's like an emergency account. That's fine. I totally understand that. Okay, but you want to first know how much cash do you have. All right, personal property. Do you have, now when it comes to raising funding, many times you can bootstrap. You can sell things that maybe you don't use, and we all know about the friends and family or selling stuff on eBay and raising money that way. Those are all great creative ways to raise capital, okay, for your startup. Now, you also want to list your assets is your home. If you own a home and you have equity, or let's say your home's paid off, that's an asset. How much equity you have in your home, because you can use that as a way to raise capital for your startup. I'm going to talk about that as well. Then your value of your investments. Okay, so if you have a 401k, I'm not going to get into that particular strategy where there's a rollover business into a startup. It's called ROBS. That's a different type of funding product that if you have 401k or a Roth IRA, you have retirement, you can roll that over to get funding for your startup without getting the tax penalty of pulling out money out of your retirement account. A lot of people do that if they're trying to buy a franchise, etc. But you want to know what the value of your investments. What's the cash value of insurance policies that you have? Now, why am I telling you to do all this is because you're doing an assessment so you can determine what your options are. What's your strategy going to be? And that way, when you launch your business or you raise capital for your business without bringing on, let's say, investment partners or giving away equity into your business, etc., we're just giving you some creative ways here in this video. So once we've done that, now let's say credit is your asset. Let's say you have good personal credit. You have 680 or higher credit scores. You have good credit card accounts. You have decent credit limits. And what I mean by credit limits, if your highest credit limit is under $2,500, it's not, you want to get your credit limits to at least over $5,000 on credit cards, okay? Because that's going to help you raise more credit approvals on the business side. Because what happens is when you're applying for business credit cards with mainstream business credit card issuers, they look at your comparable credit. They look at, of course, they're going to pull your business credit report if you're more of a seasoned business. But if you're a newly formed startup, the main factor they're going to look at is, of course, your personal credit, okay? Because they're going to look at your comparable credit. How high are your credit limits on your personal side, on your primary accounts? How long have you had them? Who do you have them with? Okay, so the higher the credit limits you have on as an individual, the greater the approvals you're going to get, and the higher the limits you're going to get on the business side, because that's how they use comparables. Okay, business credit cards are great because they're a no-doc program for you as a startup. What does no-doc mean? That means that you don't have to worry about providing any type of bank statements for the business, no financials because you're a startup, obviously. There's no financial statements or anything like that. A no-doc for business credit cards is all you're going to need to provide, if the bank requires it, is maybe your EIN letter or your articles of incorporation, your formation of your business, and that's it. Okay, so business credit cards are great. What you're doing here is you're co-signing for your business. So you're going to personal guarantee these business credit cards, and I want to make sure you understand what a personal guarantee means. Some people misunderstand that a personal guarantee means it's going to report on your personal credit. No. Only in the event of default, if your business doesn't pay on a business credit card, then that card issuer will come to you to make good on paying that. If you don't pay, then they'll report it negatively to your personal credit, of course, as well as your business credit. That's what your PG is. You're liable if your business doesn't pay. Now, that's going to be a requirement. Many of the business credit cards that we're going to talk about and that you can get also through our funding program only report to the business credit bureaus. So you don't want to acquire business credit cards that report to your personal credit. You only want to get business credit cards that report to business credit. So business credit cards are great as one of the tools to get funding for your startup because you can get 0% financing for 6 to 18 months. Many business credit card issuers offer 0% intro APR on purchases. So if you're trying to maybe start a marketing campaign, you need to buy some, let's say, small equipment for your office, etc. That 0% financing is huge. You can't get that with lines of credit. You can't get that with a loan. You can only get that via business credit cards. But you want to make sure that that you have a plan to pay back on that, because obviously when the interest rate kicks in, that can be pretty expensive if you're not trying to pay that off. Okay. Another great thing with business credit cards is they keep your personal and business expenses separate. This allows you, come tax time, if you need to, when you're filing your returns, all your business purchases are on your business credit card statements and your personal expenses are on your personal credit card statements. This also helps you build business credit. As a startup, your main goal should be to build up the credit worthiness of your company. Not your main goal. Obviously, you want to build a profitable business, but I'm talking when it comes to credit, when it comes to building up your company, that's credit worthiness is going to play a big role in the future when you apply for additional funding. That's why lenders and banks can then, and creditors, suppliers, vendors can now pull your business credit. Okay, so building business credit is paramount to a successful startup for your business. Now, establish multiple banking relationships. Now, you don't want to just get one business credit card. You want to have multiple business credit cards, even as a startup, because those cards, each one of those represent a relationship with a bank card issuer. And that can result in future credit limit increases every 6 months when you request credit limit increases, or they do automatic reviews and give you a credit limit increase. And the beauty with business credit cards is they have much higher credit limit increases compared to personal. The second thing is those card issuers may offer additional credit card products for the business. So that'll give you more opportunities to get more cards. Or that particular card issuer may offer a lending product. Like American Express not only offers credit cards, but they have charge cards. They have actual lines of credit products, loan products. Okay, so that's really important to understand that you want to create multiple banking relationships. Now, the other thing that's not mentioned too much is receiving targeted business credit offers. So when you're in a particular card issuer's ecosystem and you have now a card with them, now what they'll do is they'll present you other offers, okay? Because you're now in a position to get additional card products that they offer. So you may receive those offers and not even want them, okay? But that's a benefit when you get business credit cards, okay? So, and then of course, you get the big rewards, cashback rewards. There's people who do videos on how they really get lots of rewards and travel perks for their business using their business credit card. So that's icing on the cake. Okay, so now one of the business credit cards I want to share with you, or actually two from American Express, is the Blue Business Cash Card. This is a great card for you as a startup. Obviously, you want to have at least a 680 or higher credit score. Now, if you already have an American Express credit card as a personal credit card, then definitely this is a no-brainer here for you, because you won't get a hard pull if you apply for this, and it help you build your business credit. The second card is the Blue Business Plus credit card. Both of these cards have 0% inter APR on purchases for 12 months, 1 to 2% cash back on the first one, and then you get 1 to 2x points on the second card. $250 statement credit on the first one once you spend $3,000 in the first 3 months, and then you get 15,000 points on the second card if you spend $3,000 in the first 3 months. So those are the different perks with those cards. No annual fee for either one of these cards. So these are great ways for you as a startup to get access to credit for your business. And remember, you do have to have the 680 or higher credit score. If you're already in American Express, that's much better. Now, I want to talk about another card that I recommend for you as a startup is the Inc. Business Unlimited credit card from Chase. You also have the Business Cash credit card from Chase. You want to also have a 680 or higher credit score with these cards, 0% inter APR for 12 months. Both cards have cashback rewards. Now, the second card, you want to make sure, I would recommend you be in the 700 or higher credit score range if you apply for the Business Cash credit card with 5% cash back. No annual fee on these cards. You spend $6,000 the first 3 months to earn your bonuses. You don't want to apply for any of the Chase cards if you fall into the 524 rule. Lots of videos on that. That basically means if you set up 5 credit card accounts, 5 new credit cards in the past 24 months, you don't want to apply for Chase because they'll automatically decline you. Okay? So those are the credit cards I recommend. Now, many people if your goal is to raise as much credit as possible for your startup, and you have really good personal credit, then I recommend our business credit card funding, because that's where we actually bundle business credit cards for you. In 14 to 20 days, you can get up to 4 to 5 cards strategically placed. We get these cards for you, and you get up to $150,000 total credit limits. This only reports to Business Credit Report. So this will give you 4 to 5 new banking relationships. This will help you build up your business credit, obviously. It takes us 14 to 20 days to acquire this, and there's no fee up front to get these business credit cards. The thing I want you to realize, though, is most people say, well, I want $150K in business credit cards for my startup. But then when you look at the personal credit, you want to make sure that's where I told you that amount in raising for a startup is going to be solely based on how strong your personal credit is. What I mean is, how high are your credit limits on your primary accounts? Not authorized user accounts. I'm talking about your primary accounts. So if you have $20,000, $30,000 credit cards on your primaries, then you're going to have a great funding projection on the business credit card side. Okay, not authorized users though. Okay, and more importantly, these have to be cards that you've had for many, many years. Okay, if your highest credit limit is $5,000 or $15,000, then you may get a $40,000 or $50,000 projection. Okay, but don't expect $150K if your credit limits are much lower than that. So you pre-qualify is go to businessfundingreview.com if you want us to review you. We don't do a hard pull on your credit for the review. You're supplying a copy of your credit report. It takes us 24 to 48 hours to do the review, and then we present to you our funding projections and how much in business credit cards we can get for your startup. Additional benefit that we offer is access to our cash liquidation service. This is a separate service that we offer for our clients, which allows you to pull up to 90% of your credit card limits in cash without worrying about any type of cash advance fees. You benefit from 0% APR if you have an intro APR on those cards. And there's no cash advance fees you have to worry about. So that's an add-on service that we have, which is really, really exciting. Okay. Now, what if credit is your asset? What's another option other than business credit cards? So if you need actual cash deposited, then I recommend a personal loan. So if you're trying to borrow $1,000 to $50,000 in cash, paybacks periods average is 2 to 7 years. Your rates are going to range anywhere from 6%, can go much higher than that, but the average is 11% according to Bankrate. This is a fixed monthly payment, and it's great if you have some purchases you need to make for your business. So if you have some equipment you need to buy, and you know it's going to be something that you're not going to pay back right away, then maybe a loan may be an option for you as opposed to putting it on a credit card. Okay, so what are the things they look at for a personal loan that you can use for your business? Is, of course, your credit. That's going to determine what your interest rate is going to be, your income, and your employment status, and, of course, your debt-to-income ratio, which is going to play a big role. Because many times people have the credit, and you have income, but your debt to income ratio disqualifies you from getting a loan. So how do you calculate your debt to income ratio? So what you want to do in this chart right here, you add up all your monthly debt payments that you pay. So let's say your mortgage is $1,600 a month, and then your auto loan you pay is $300. Your credit card payments right now, minimum payments total $300 a month. Student loan payments $200. So you have $2,400 a month going out every single month for your monthly debts. And let's say your W-2 income is $6,000 gross income every single month. So you're going to divide that and you're going to get your debt to income ratio. In this example, it's 0.40, 40%. So this particular example, you would be able to qualify for a personal loan. The benchmark is under 43% according to Bankrate. So if you have a debt to income ratio of like 50% or 55%, then you're more than likely not going to be able to get approved for a loan. There's no way. Okay, so that's where you want to see what's your debt to income ratio when it comes to getting a personal loan. So those are the factors that get weighed in. Now, I want to give you some charts here on average rates by your credit score. So this is what you can expect for a personal loan, what type of rates you're going to get right now. So obviously you'll see if you're in the 720, 850 range, the average loan interest rate is 10 to 12%. And then that can go all the way up from 28 to 32% if you're in the 300 to 629 range of credit scores. And yes, people are getting loans at those really, really, really high rates. Now, here's some average rates by online lenders, okay? Now, you'll see I listed here a couple of online lenders that do soft pull for pre-qual. What's great about that is they will pre-qualify you, and they'll do a soft pull on your credit, so it's not a hard pull to pre-qualify you. But if you decide to move forward, then they will do a hard pull. So Avant right here, 9.95 to 35.99%. And then you have Best Egg, Prosper, SoFi. So SoFi right here on their website, it's really simple. You just click here to view your rate. And they're going to want, you'll see right here, they're all disclosed here that this won't create a hard check on your credit. Then you'll see here with Avant, this is really simple. You just go to their website, you check your options there. They do $2,000 to $35,000 on personal loans, and again, this doesn't affect your personal credit. They also disclose that right here for the pre-qual. But that allows you to kind of determine and kind of shop around what you could expect on a personal loan. You got Upgrade here, also does a soft pull. The next thing is, let's look at the average rates by banks and credit unions. You'll see, obviously, the credit unions and banks are a little bit more competitive. You'll see they're about 1% less than what online lenders charge. On some instances, you'll see they're more in the 7 range as far as the low side goes. They do have auto pays. You definitely want that. Sometimes they give you a discount if you're on auto pay with a loan. Okay, you'll see PenFed Credit Union does a soft pull. You'll see these rates here can get pretty hefty here in the 20s on regular banks as well. Now, like I told you though, if you already have relationships with whether it be a credit union or a bank or even an online lender that you may have had a previous loan with, then that's where you want to go to get additional funding for your startup because you have a relationship with them. If you don't want to shop around, we do have a personal loan funding program where we actually get the loans for you. Now, with the lenders that we have, we require a 680 or higher credit score, 50,000 annual income. That's your adjusted gross income. Now, the loan amounts for the lenders that we get you funding for is 25 to 300,000 in loan amounts. So a little bit more aggressive. Higher amounts, because some of these online lenders may even lend you $5,000 or $10,000. Ours start at $25,000. Okay, but if you're in that range and the repayment terms are 3, 5, or 7 year terms. Okay, processing time for us to get you an actual loan that you can use for startup for your business is 14 to 20 days. Same process, businessfundingreview.com. Now keep in mind, if you have a 680 credit score and you have 50,000 in income, that doesn't guarantee you're going to get a loan. The reason why is we also are going to look at your debt to income ratio. Okay, so that's very important. Now, when you see personal loan funding, it says low doc. What does that mean? Well, with low doc, you have to prove income for this particular program. Even with online lenders or banks, They may want to see your pay stubs. With our funding program here for personal loan funding that you can use for business, we want to see your past 30 days of pay stubs if you're a W-2 employee. Now, if you're self-employed, 1099, then we're going to want to see your tax return. You have to be able to prove your income. Let's say number 3, if equity is your asset, then you may want to consider a home equity line of credit. Let's say you have equity in your home. This is a strategy, this is an option that many people use if they have lots of equity in their home. It's a line of credit, so it's not a loan. You can get a loan against your equity of your home, but in this example, we're talking about a HELOC. This is a line of credit with the interest rate is variable, so it changes. This is interest-only payments, and your draw period is typically 10 years. So that gives you up to 10 years to draw on your line of credit, and you're paying interest-only payments, so your payments are very, very low. But after the 10-year term, you have to either it converts into a loan, or you can get another HELOC, but you have to pay obviously the principal back at that 10-year period. And this is best for large purchases or expenses. We have the HELOCs, personal loans, and business credit card funding. You'll see, I don't need to go through every single thing. You can look at this. Obviously, it's self-explanatory. You'll see that the HELOCs are a lot more slower to fund because they got to get appraisal on your house. There's a lot of paperwork. You have to make sure you have the equity in your home, etc. Where a personal loan is fast, as well as business credit card funding is fast. Application criteria is full doc. Personal loan, all we need is pay stubs and driver's license. With a business credit card, all we need is driver's license, EIN letter, and articles of incorporation. That's it. And there's no revenue requirement when it comes to business credit cards. No revenue requirement for a HELOC or a personal loan as far as the business goes. Okay, but you'll see there's no income verification on HELOCs, but we need to verify your income with your personal loan. And then, of course, you'll see the doc requirements on financials, tax returns, and bank statements. You more than likely need that for a HELOC. For personal loans, you don't need that, as well as business credit cards. Okay, so I hope you found this information helpful for you. We just broke down 3 different funding options to fund your startup. If you found this information useful, give us a thumbs up, click subscribe. That way you're always notified every time we come out with a new video. With that, make it a great day, and check our website out, businesscreditbuilders.org. We have a done-for-you funding solutions, which you talked about here in this video, and we also have our step-by-step business credit building system. Make it a great day. We'll talk to you real soon.